You're about to hear my conversation with Dustin Reed. We talk all about the recent Fed and Bank of Canada meetings. We also get his perspective on what's to happen in the first half of 2026. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. I'm your host, Matthew Schnurr, and I'm back with our chief fixed income strategist, Dustin Reed. Dustin, welcome back.
Hey, Matt. Great to be back with you.
So we've recently had a meeting from the Fed and Bank of Canada just yesterday. Let's start with the Fed. They cut 25 basis points, which was largely expected by markets most recently, although getting there was a bit of a challenge as markets repriced it fairly substantially since the last meeting. I'd love to get your reaction to the cut and anything that you're taking away from that meeting.
Yeah, you're right. It was very much of a round trip in the weeks going into the meeting, with the market almost fully priced a few weeks ago, and then moving to maybe about 40% a week or so after that, and then coming almost around full circle and going into the meeting 24, 25 basis points priced for the meeting, of which the Fed did cut. So no surprise there, quote unquote, with the last print. Yeah, I thought the meeting was, interesting on a few different levels. The statement was little changed in my opinion. Nothing really, the formal statement, nothing too much in there. December meeting for the Fed is a forecast meeting, so a new outlook with the usual dot plot and the economic side. On the dot plot, the previous forecast meeting had one cut priced in for 2026. And the update that we got this week from the Fed kept that one dot, even though it was pretty close to moving to two, i.e., 50 basis points for 26 as opposed to 25 basis points for 26. Really only needed one person to move a bit lower to kind of move that median dot and get from 25 to 50 for 2026. But that didn't happen. We obviously had three dissenters at the meeting, two looking for no cut whatsoever, and then Moran was clearly very dovish and kind of the Trump's latest appointee to the Fed, not only arguing for 50, but also presumably, we don't actually know for sure, but it seems very likely that his dot moved lower for 26 down to 2%, which is obviously quite a move when you consider that the 25 basis points yesterday moved the Fed funds rate down to 3.5 to 3.75. The
Pretty
25
aggressive.
basis point.
Yeah.
Yeah, so 2% is is a long way from that, right? And that's the long term, 12 months or more away, which is fair, but no one else is even close to that. The press conference, which is often the case, was kind of where the real fireworks happened. My impression from the press conference was that Powell seemed to be pretty comfortable with where rates are now with that move. And he talked a little bit more in the press conference in my opinion, than he had on previous press conferences around the idea around neutral. And you and I have talked about this a lot over the last number of years on these podcasts. So with the Fed moving down to, again, 3.5 to 3.75 in the Fed funds rate, this 3.5 neighborhood is the area that I've been citing, and a lot of people have been citing too, to be fair, that it seems to be if you think of just a normal distribution curve and where the majority of people might sit in terms of their estimate of where neutral is for the U.S. economy, neutral Fed funds is for the U.S. economy, 3.5 seems to be as good a place as anywhere to start that conversation. And Powell effectively said as much yesterday. Now, he seemed to suggest that it may be the top end of it, which would seem to suggest that if there was another cut, not that I'm advocating for another cut, but if there was another cut to 3.25, 3.5 from the current 3.5, 3.75, that it might be neutral. But this, now we're having more of a conversation about it publicly because 3.5 is part of the conversation at the bottom end of the Fed funds range. So that language and emphasis and a little bit more time spent around that, I think, is important and says a few things. One, that's probably where it is, at least for now. And two, those that have been looking for that to be a level, 3.5 to be a level, are probably, let's say, not wrong. I don't know if they're right, but they're probably not wrong. So I think that's very important in terms of how to think about Fed funds going forward and what the Fed may or may not do. Said slightly differently, you might need to see an additional deterioration in the economic outlook for the Fed to now move one or more below, at least under this chair, going forward. Powell did say something really interesting at the press conference. He was talking a lot about the labor market, and he cited an average job growth rate of 40,000 between April and September, which is the latest data that we have as we record here. Although this coming week, next week, we will get the next 2 months of job data, the October and the November data. But for those months, April to September inclusive, an average job gain was about 40,000 officially. But Powell came out and said something really interesting. He came out and effectively said that the job numbers that are getting printed are probably too strong. And they're probably, he's effectively saying that there are probably revisions to come, which we know that there have been revisions downward over the last few years. And he thought and he got very specific. He thought the revisions would be worth 60,000 negative per month going forward, which would obviously put the average job growth, so to speak, at negative 20,000 on a run rate from April through September. That caught a lot of people off guard. I think on a few, one being that he would even talk about it, two, that he would be that granular, and then maybe three, that it was that severe. Although when we get these annual revisions, and they are in the 6, 7, 800,000 neighborhoods. So 60,000 a month is not out of range there. They're obviously like 60 times 12 is 720. So you're kind of in the wheelhouse, but still just to say it and hear it from Powell of all people was a little bit shocking for the market. And in my opinion, the market, almost irregardless of what happened in the statement and the dot plot, economic outlook, and the rest of the press conference, I think the market kind of latched on to that idea of, wow, the Fed thinks that like already, even before the revisions, that job growth has been on average negative from April to September inclusive. So when you think about a break-even rate, a new break-even rate, maybe of 50,000 plus in terms of jobs in the U.S. to kind of keep the labor market going, and Powell and or the Fed is running at minus 20. Okay, what does that mean for policy? So a lot of the statement and the comments from the Fed and Powell in particular were, we would say, on the hawkish side. But then there was what I just talked about, and that kind of put a bit of a dovish spin on the whole thing. And you saw markets trade that way. So equities were generally bid. Fixed income was also bid, so prices higher, yields a bit lower, and high beta assets generally performed well. Dollar sold off, emerging market currencies did well,
Mm.
outperformed, that sort of thing. And we saw a bit of a follow through on that today, Thursday after. So thinking about all that and what it all means for markets going forward. So maybe that's kind of what we got, and what I think going forward. We've been on this view for a while that market pricing for Fed cuts for 2026 needs to get priced out, and I still think that's the case. The Fed is stuck in a tough spot. I don't particularly envy it. Inflation is high and above target, and has been above target for a long time, over 4 years, 4.5. And the labor market, while in my opinion not falling off a cliff, massively deteriorating, is still clearly deteriorating. So you have hot inflation and cool labor, and you have a dual mandate to have inflation closer to 2% while maximizing full employment. So how do you do that with effectively one tool? So the Fed's in a tough spot from that perspective. Powell said yesterday, when you can't really choose between the mandates, then generally the idea is to do nothing. That to me was kind of the hawkish view in a way, where you've got the market that's still pricing around 55, 60 basis points worth of cuts through the end of 26. But Powell's effectively telling you that there's very little happening and there's only one dot, or 25 basis points priced, or at least estimated, I should say, by the Fed for 2026. So it's a bit of a conundrum meeting. And from that perspective, you've got kind of a hawkish take, but then Powell has talked about the labor market in a granular way that we really haven't seen before. So I'm starting to think about the Fed in a slightly different way here for 2026. And we can talk about some of these things if you want and there's time. But sitting here mid-ish December, obviously it's the last meeting of the year. Everybody knows that Powell is very likely leaving the chair position and probably the Fed entirely in May of 2026. So there are 3 meetings before Powell leaves: January, March, April. And there are 5 after him, June, and then 4 in the back half of 26. And so I'm thinking about it as pre-Powell and post-Powell. I think there's a very good probability here that the Fed under Powell's leadership does not cut again. And there's about 19 or 20 basis points of that 60-ish for 26 that is priced through April. So I think that needs to get unwound. But then, of course, the risks around the new Fed chair, whoever that is, coming in May and potentially kind of putting their foot on the gas and maybe cutting rates when it may or may not be required. And we'll see how the economy is working at that time. But our view for a long time, particularly for the first half, is that the U.S. economy is going to generally outperform, and the need for additional rate cuts, particularly from an inflation perspective, is probably not required.
That's great. Just sticking on, I guess, the upcoming chair, the post Powell chair. Recently, there's been reporting that Kevin Hassett seems like he's emerged as the top runner to succeed Powell. I'm curious what you think that means from both the, you sort of alluded to it on the rate side that the new chair could be more dovish than Powell is. So I'd love your thoughts on what you think that a Hassett chair would mean for rate cutting. And then also what it would mean for central bank independence. We had talked about that previously. And obviously, comments coming from President Trump put some questioning regarding the central bank independence. And curious on your view on that front as well.
Yeah, they are very important questions and top of mind, I think, for investors. And even within my kind of day to day, week to week space within the fixed income side, you could argue that it's maybe almost most important from fixed income as an asset class perspective. This is a big deal, and you and I have spent a lot of time talking about it on these podcasts, on the Get Sharp podcast, of course, as well as a full topic. And we are at the cusp of seeing how this is going to go after what seems like a very long wait around this question. So I don't know Kevin personally, but I know people that do. Clearly, he has been out publicly pushing for not only lower rates but lower rates more quickly and sooner. And I get it. I see why he would like that, and I can understand the rationale. I don't particularly share that rationale at this point because I don't think the labor market's falling away too fast. And I think, particularly for the first half of the year, economic growth in the U.S. can be quite strong based on the consumer side as well as fixed business investment, i.e., capex or AI capex. But I do think he will cut rates. I mean, it depends on where the economy is at, what the data is showing, and what Powell has done since this discussion and this meeting. If I'm correct and Powell does nothing between now and when he leaves in May, then there's probably a good chance that if it is Hassett, that he's going to cut rates. I don't know if it's going to be aggressively, but continue to cut rates. The people that I speak with who know Kevin or know are closer to Kevin than I am, almost all of them say the same thing, which I think is interesting. And that thing is that he's a lot more orthodox than he is coming across in the press, and maybe within the administration or under the umbrella of this administration. Again, I don't know if that's actually true or not true, but it's interesting to me that the sources that I speak with basically all say the same thing one way. So you wonder if he comes in and the economy is doing very, very well, be well into Q2 at this point, and the economy is doing really well. Is he really going to follow through on that? And would there be some concerns, from the administration having installed him, all those things, and he's not cutting rates? It'll be interesting to see. I mean, the last 2-3 weeks have really seen him move higher in expectations. You look at Polymarket, at some point, I think he was at 80 or 85%, maybe even slightly higher than that. There was an article, though, in the last 24, 36 hours from when we're recording now that seemed to suggest that Trump was ready to make an announcement, but has pushed it off until the new year, which would seem odd because Trump effectively said that he was only looking at one person, and then separately that Hassett was, a possibility. So, not totally sure what's going on here. We've generally expected that around the turn of the year, whether it's slightly before, i.e., this month, or slightly after, i.e., next month, January, that we would get the announcement from Trump on who it would be. But the bond market hasn't. I mean, the bond market's moved a little bit on this, but it hasn't moved too much yet. I think some of the orthodoxy thought process is probably getting around as well. So we'll have to see. I mean, the risk here for markets, to me, as you and I have discussed before, is that, and not to repeat, but if the economy is doing well, and I spent time on this 3.5% neutral number a few minutes ago, but if the Fed goes below 3.5%, then it's probably moving into accommodative territory. Maybe it's slight accommodative or getting into more accommodative territory. But if the economy is doing well, and they're moving into accommodative territory, then that would probably mean that the market believes that there's going to be some additional inflationary pressure in the economy when inflation is already above target. And if that happens, then particularly the back end of the US yield curve, the risk is that it would move higher because, fixed income investors would want to be compensated for higher levels of inflation on a fixed rate of interest, of course, right? Fixed income. And so that's when you start talking about policy error and big steepening in yield curves and bond, probably a little extreme, but bond vigilantes and all those sorts of things. And that's definitely the concern around markets. And it's not just a fixed income thing. I think it's fixed income first, yes.
Sure.
But if the curve moves higher, and I would say higher from a step function perspective as opposed to a slow grind, that's going to squeeze equity valuations, right? And that's going to have an impact on high beta assets like high yield credit, like EMFX, emerging market foreign exchange. And to part of your question, on the dollar side, I think it's potentially not great. For two reasons. One, from just a regular textbook interest rate parity perspective, right? Fed's cutting rates, and so the interest rate spread's not as good, and so generally the dollar weaker on the carry against other currencies, sure. But then from an independence perspective, why is the Fed moving into accommodative territory when maybe it doesn't need to be doing that? And we'll see again what the data and where rates are at the time and, all those things. But if the market believes, and if I believe, but if the market believes that we're getting into accommodative territory for not a good reason, then it's going to be a loss of independence or a view by the market that the Fed is losing independence. And that's traditionally not seen to be very constructive for whoever it is, but particularly the country's currency. And that's a really interesting question and debate as to how that plays out for the US dollar, because the US dollar is obviously the global reserve currency of choice. And we've really never had this happen before. So it's a bit of a new thing, but I will kind of lean on my own orthodoxy and say that it's probably, from a cyclical or structural perspective, maybe more structural perspective, it's probably not constructive for the US dollar.
So I guess just summarizing that answer, it sounds like there's increased risk with Hassett coming in, that things may become more political within the Fed, but yet to be seen. And there is a measure of orthodoxy within Hassett that may make him a typical chair, call it. Is that fair?
Yeah, I think that's fair. Yeah, of the five, which I think are not five anymore, but of the five that kind of the FT scoop broke maybe 6 or 7 or 8 weeks ago now, and then effectively was confirmed by the Treasury Secretary Bessent. I think that Hassett has the potential to be the least orthodox within that set, but there are clearly people that believe that he will be more orthodox once he gets in the chair.
Perfect. Let's move to Bank of Canada next. The bank had a meeting yesterday as well, stood firm and pat. What'd you take away from the Bank of Canada meeting?
So the bank also interesting, and I think we have a bit of a differentiated view in terms of maybe not only yesterday, but also going forward. So the bank held, which was generally expected. Very little was priced in. I think maybe one basis point going into the meeting, so basically nil. And of course, at 2.25% on the overnight rate, that's the bottom end, as you and I have talked about a lot, the bottom end of the so-called Bank of Canada's own neutral range of 2.25 to 3.25%. So the bank feels that those are the appropriate level. That is the appropriate level of rates right now for the economy, with its own kind of macroeconomic outlook as well as the risks that it sees ahead. The bank's a little bit maybe more concerned now than September or October around inflation. I would say particularly headline inflation, and then even within that, particularly food prices. Food prices have come up a little bit over the last month or two, and there's some reasoning to suggest that I could see that, unfortunately, accelerate a little bit or a while. So the Bank of Canada is a little bit concerned around that. But I think overall here, the bank is pretty comfortable at this level. And I think that the bank wants to make sure that it's at the right level, I think, going forward for the next little while. The bank at the same time sees risks ahead. We've had 3 employment reports in Canada here over the last 3 consecutive months, September, October, November, that at least on a headline perspective have been very strong. But most of those jobs have been part-time jobs as opposed to full-time jobs. And we talked a little bit about the October ones in particular with kind of the Blue Jays run and jobs and part-time jobs in Ontario and what sectors those were in. We covered that off last time. And so since last time, we've had the November data, which printed in early December, the LFS data, and that came in pretty hot again. And what happened in the Canadian fixed income market, Canadian sovereign bonds, was a pretty good move higher in the curve in Canadian yields in the wake of the labor force survey from Canada. And that happened last Friday. So Friday the 5th of December. And I suspect that the bank was a little bit concerned about that because rates were moving pretty aggressively higher. Everybody knows that we're in the middle of a big mortgage market reset here, not only at the back end of 25, but also for 2026 coming up. And obviously, the bank does not want the curve to move materially higher here in a step function capacity because the resets will be even more significant over the folks that took out 5-year fixed mortgages in 20 and 2021. So I think the bank wanted to just suggest that things are a little more, there are downside risks ahead, and the bank also mentioned USMCA as a significant risk, I think, going forward. So I do think that the bank is open to either I don't want to say a cut or a hike as its next move. I still think that the bank will cut before it hikes, but the market has started to jump ahead here on the back of these three, at least from a headline perspective, somewhat strong employment reports in the country, which the market was not expecting. And of course, at the same time, the unemployment rate has moved from around 7.1 to 6.5 over that time. So quite a bit stronger. But I think there's a reason for that because people are leaving the labor force, and that could be because of the immigration policy partially. And you're seeing people exit the labor force. And so the unemployment rate is coming down maybe a bit artificially. So, is that strength real, right? Are these part-time jobs that we're seeing in the labor force survey, how real are they? Is that going to contribute to economic growth materially? Is the unemployment rate coming down for the right reasons? What's happening with the participation rate? What are wages doing? All those things, like we're all looking at that. The bank's looking at that. But the market is starting to price in hikes by the Bank of Canada by the end of 2026. The last I looked, there was about 25 or 30 basis points worth of hikes priced by the end of 2026. And we think it's a bit premature to have that market pricing. We actually still see it the other way. And I still see potentially two cuts by the Bank of Canada before mid-year 2026, so June 2026. And I think that's important because if that's correct, then the bond market, and maybe not to an extent the equity market, domestic equity market, but I would say the currency here in particular and then the bond market are probably going to be significantly affected if I'm correct, and the market needs to recalibrate back towards cuts as opposed to hikes in 2026. And again, a lot of the reasons why I think that that's happening, first of all, as you can probably tell, I don't believe that the labor market numbers, even though the headline is strong, I don't think that the details are particularly constructive. The second is that Q3 growth, again, although the headline was strong, better measure, in my opinion, is final domestic demand as opposed to GDP. And final domestic demand was negative because household consumption was negative in Q3. I think that, at the end of the day, it's population growth. Immigration is a big driver in Canada, or has been a big driver in Canada of population growth. But population growth has effectively gone from 2.5 or 3% to zero in a relatively short period of time. And that is a big deal when it comes to the economy going forward in terms of consumption and all those things. I think that's one of the reasons why we saw negative household consumption in Q3, because it's coming in the middle of a very big change in immigration policy and in the it's not about immigration per se, it's about population growth, but the impact that immigration is having on overall population growth or lack thereof. And the fourth thing I would cite is I think the housing market is pretty weak when you look at whether it's prices or power of sales or how long it takes for houses to sell, or who's actually starting new projects or projects that were started that are being pulled, or new construction projects that were done in, or at least started in 21 and 22, that builders can sell units and have to make other arrangements. I think these things are out there and they're percolating, and I'm concerned. And of course, we know that, as we say, we call it FIRE, finance, insurance, real estate. Jobs as a percentage of the economy is significant, and as a percentage of GDP is quite large compared to other developed economies. And so if finance, insurance, particularly the RE, the real estate side, fall off significantly, or at least more than expected, I think that that's going to be pretty significant downside or headwind for the economy. So I'm not giving up on a Bank of Canada easing cycle yet, even though the market seems to have flipped the other way. So the next couple of quarters here in Canada through June, I think, and maybe into Q3, but definitely the first half of the year to 3 quarters of the year in 26 are going to be, I think, very, very important, very, very telling here. We'll see if we're correct on that one.
Great. Well, why don't we stay on that theme of what you're expecting out of the first half of 26, but open the aperture a little bit further and maybe talk about what you're expecting out of US and anything interesting in global as well.
Sure. Yeah. So it's a pretty good wrap probably on the Canadian side. So I don't necessarily need to say that one again, as you suggested. I think, again, on the US side, I do think that kind of these two waves, pre Powell and post Powell, I do think that market cuts that are currently priced for the Fed through at least the April meeting, the first three meetings of the year, will get unwound. And I think the US economy will perform pretty well. It looks like Q3 growth is pretty solid here in the US, maybe 3.5 or 4%. Q4 obviously has some risk to it, right? What happened in Q4? Well, the first half of the quarter, there was the federal government shutdown. And so workers were not going in, people weren't spending as much. It was clearly a problem. So, but, it's always about, or almost always about, what is known and unknown and what's in the price and not in the price. I mean, everybody knows that there was a government shutdown, and everybody knows that it's probably not constructive for the US economy. So I think a lot of people are expecting some weak-ish data as it pertains to October and maybe to an extent November. Obviously, the shutdown was most of the first half of November as well. But kind of beyond that, we're obviously sitting here early mid December. What don't we know yet? We know that the consumer seems pretty constructive here. Hyperscalers and I think other firms, but hyperscalers are going to be spending a fair bit on AI. And I think that goes beyond the hyperscalers. When I think about even just finance and banks and asset managers, and what we're doing here, at Mac, and the story better than I do. I think the AI investment story and just the capex investment story in technology is extremely important. And I think other firms in other industries and sectors are also playing catch up there, and the money spent is significant. So I can see that fixed business investment part of kind of the old textbook GDP equation, being pretty strong for the first half of the year. Then there's a couple other things going on too. So not to go review history too much, but everyone of course remembers the OBA, the One Big Beautiful Bill Act from the summer of this year of 25. A lot of the tax cuts for middle income earners in the OBA bill do not kick in until 2026. And so we're expecting to see a fair bit of tax credits or cash in hand, or however you want to say it, for a decent chunk of the population for the middle income kind of income set later Q1 and Q2. And that's probably a good tailwind, I think, for consumption, for the US. And I also think that we're going to see a pretty good liquidity in the economy. And what I mean by that is this, as the government shut down, they weren't paying people, right? No surprise. So what happened is the government coffers moved higher and higher. So people look at the thing called the TGA, the Treasury General Account, which is basically the Treasury's account that sits at the Federal Reserve. And that ballooned to, I don't know if it was a record, but it was over $1 trillion, which is pretty high. Usually the balance there is around 300 to 400 billion, which obviously is a big number, but 300 to 400 billion versus say a trillion or 1.1 trillion. That's because they had money because they weren't paying people, right? But now that everything's open again and kind of back at it, that money's flowing back into the economy. So think of like the shutdown as liquidity being taken out of the economy, and then as the government opens up and they start paying back people, like back pay, and obviously going forward as well, that money that was drained out of the system, as it were, goes back into the system for paying and that sort of thing. Of course, there's a multiplier effect as well. So we think that there's a pretty good tailwind from the liquidity story also happening, maybe now, to be fair, but definitely in Q1 and maybe H1 in 2026, as that effectively gets paid back, as it were. So there's probably a couple other things going on there too, but again, one of the reasons why I'm pretty constructive on the U.S. economy for Q1, one of the reasons why I don't think that at least a Powell-led Fed is going to particularly cut rates unless the labor market really falls away. It seems to be, I think, more likely than not. We spend a lot of time with emerging markets in our portfolios because it's a great yield capture
Right.
for us. And important to emerging markets is this idea of carry and can, carry as a thematic continue in markets. And I think it can. I don't think the dollar is going to move materially higher here. And I don't think that US rates are going to move materially higher here. They both have risks of moving higher, of course, but I don't think that that's a massive risk from my perspective. And some of these yielders, these high yielders like Brazil and Mexico, are yielding so much. And Brazil is basically just about to turn the corner, I think, and start in terms of starting its rate easing cycle. That they're pretty attractive carries. So I do think that there's very good yield enhancement and yield pickup on the emerging market side on from a carry perspective. Especially as Brazil starts to cut and begin its rate easing cycle from 15.15% in Q1 2026. The Japan story, I think, is important to keep an eye on here. I'm interested to see what the new prime minister, who is very active around fiscal spend, what she is focused on for fiscal 26. If it's a really big spend, we could see the back end of the Japanese bond curve, JGB curve, move higher. And that is a risk probably to financial markets in a way. And I say that because it might change the balance of flows within fixed income and FX within kind of the global financial system. We could see money that would maybe be usually going to the US or other spots, quote unquote, coming home to Japan from a domestic investor perspective,
Right.
because those yields are hitting levels that we haven't seen in Japan in years and years. And so investing at home for a Japanese investor, domiciled investor, as opposed to investing abroad is becoming more attractive by the week. And so that has an impact on global flows. And you could say the opposite in a way too, right? The US investor or Canadian investor or other investor, European investor, is maybe looking at Japan as an option. Obviously, debate whether you currency hedge or not, and that adds a different layer, of course. But just from a pure outright yield perspective, the nominal yield, JGBs haven't looked this attractive in a while, and I know that a lot of global investors are looking at that. So, do you have European investors that are not investing in EGBs and European government bonds and are looking to diversify away and maybe investing in Japan? And that hasn't happened in a long time. And so it's kind of an interesting dynamic here. If the JGB market runs away, i.e., prices lower and yields higher, maybe a lot higher, then it could upset the carry trade dynamic around EM and EMFX, so EM local currency and EMFX. So that's something I'm watching for the first half of the year because it's not a massive part of our portfolio, but it is an overweight in our portfolio, EM local currency and EMFX. So if that carry trade, it looks like it's not going to be as attractive or maybe even completely reverse, clearly want to be ahead of that. And the Japan story that I just outlined could be one of the drivers that causes that to happen. So that could be a thing. Let's call it, as I say, a thing that's a risk in 2026.
Just unpack that.
Yeah.
How the rise of back end within Japan leads to carry trade unwind in EM.
Yeah, so Japan has generally been seen as a low yielding currency
Yep.
and yield curve. And so within the carry trade environment, there's kind of two ways to look at it. One is you short the low yielding asset to buy the higher yielding asset,
Right.
and then another way to look at carry trades is just financial conditions are easy. I'm just going to be long high beta assets, which is kind of a bit more of a macro way to look at it, or an additional macro way to look at it. People have generally been short Japanese assets for that reason for a long time, and
Sure.
those shorts, I don't want to say they're clearly not as large as they used to be, but they do still exist. And if those shorts all of a sudden get massively covered, and you could argue over the last 3, 4, 5 weeks, particularly on the JGB side, those shorts have been getting covered, and that's one of the reasons why the move in the yield curve has been so significant higher. Then you lose that, we call it a funding assets. You short something, you use that as a funder
Got it.
to fund a borrow. You fund a higher yielding asset or a currency or curve, globally outside of wherever in this case Japan. And so if that moves really quickly and you kind of have a bunch of stop losses and people can kind of recognize that from, I'm sure our listeners recognize it from an equities perspective. If that happens within in any asset class, in this case, kind of the Japanese government bond side, and that happens relatively quickly, then it can cause a real distortion in the market. And people don't want to hold risky assets in that environment.
Got
And
it.
EM is generally seen as, a higher beta risky asset. So this is how macro and all these things around the world are connected. Like, why is what's happening in Japan going to cause a problem in Brazil, right?
Right.
But that's kind of the linkages in the chain. So, as a macro person, and kind of watching a few different markets around the world, these are the things I think about from a from a risk allocation perspective or risk management perspective, and where we want to add alpha, and how is positioning in trades. Are trades crowded or trades not crowded? The Brazil trade is a great trade, but it is probably somewhat crowded. And so, if something went kind of boom in the middle of the night on the Japan side, I would expect that people would take profits on that Brazil trade relatively quickly. And if everyone's running for the same door at the same time, it's certainly not great. You see pretty significant downside price discovery. So that's generally the way I think about it, the way it works.
Dustin, thanks for going on that detour. I'm going to call it here. Really great conversation. I learned a lot. Thanks so much for coming on.
Yeah, same here. Thanks very much. Great to do this one with you.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.